we're above the congestion zone that preceded the bear, which is down lower. But we're even price chart is saying, hey, I'm out of here. Why do you keep selling me? I've earned my way. It's not like I've had 10 months up. I've had a 1 year of sideways, and now I've had, 2 months up out of that zone. I'm hardly old. By our metrics, you're not at least a bit overbought. And yet everybody's still claiming it's got to go down, but it's up 12.9% since the April close, whereas gold went sideways. What's going on here? Well, it indicates to us that silver and the gold and silver miners are shifting to outperform mode versus the mama metal. Yeah, gold's going to resume strongly, but they're going to outpace us on a percent basis. And I think a lot of that's going to occur between now and year end.
Silver and silver mining stocks are on a trajectory to outperform gold in percentage terms through year end, while gold has moved sideways. Key drivers include increasing industrial demand, structural supply constraints, and favorable technical conditions. With the gold-to-silver ratio still at historic extremes, a reversion is likely, all signaling further upside for silver and miners. Analysts expect silver to outperform gold through year-end and into 2026 due to its undervaluation at a roughly 100-to-1 gold-silver ratio, which historically narrows in later stages of bull markets. Michael Oliver is the founder of Momentum Structural Analysis, MSA, explains that gold has traded sideways for the past 4 months in a narrow range for several months, reflecting a seasonal summer consolidation phase after reaching record highs near $3,500 in April, showing little change on a monthly closing basis. This pattern aligns with historical lighter summertime volume and idleness from major investors. Analysts highlight that this isn't a bearish top, but rather a healthy pause. The prolonged sideways action is allowing moving averages and momentum indicators to align, setting the stage for a potential continuation rally. Elliott Wave analysts from FXStreet believe gold is in a corrective wave 4 of a broader bullish sequence. Once complete, wave 5 could drive prices to new highs. Meanwhile, silver has decisively outperformed gold this year, with mining stocks further leveraging the trend. Structural drivers, including high industrial usage, limited supply growth, and ratio reversion, make it likely silver and its miners will continue to lead through year-end. The data suggests that silver and miners may continue to outperform gold in percentage terms through year-end, driven by improving technicals and renewed investor interest. Strong industrial demand, especially from the solar and EV sectors, combined with ongoing structural supply deficits, reinforces silver's fundamental strength and supports miners' outperformance. As we dive into the video, remember to subscribe and tap the bell icon so you never miss an update.
Now, gold has gone dead sideways for 4 months. In fact, if you rotate active trading contracts, which is the way we plot our gold charts, in other words, we use August future up till you're in the last week of August, and it goes in July, and it goes into delivery. Like Friday, we're August 1st, so it's in delivery now. So we rotate to October gold. And you do a continuation chart, look at the April, May, June, and July close. And gold on a monthly closing basis has had 4 months of lateral, almost dead comatose sideways closes, month to month, 4 months in a row. In fact, the close yesterday, using the new active October gold, was slightly higher than the prior 3.
Yeah, I've got the spot price.
Prior 4, excuse me. Yeah. So yesterday's close was actually a new high monthly close for gold. So everybody who's panicked about, oh, gold it's topping, it's got to go down 3,000, 2,800, whatever. Okay, you've had your chance. You've sold into it for 4 solid months, now into a 5th. If you haven't made gains yet, you're not going to make them. This is not the way gold tops. When it goes lateral, like for instance, you have a little coil down there below, there was an example of 3 months sideways, and the 4th month said, heck, I'm out of here. Okay. Now you've had 4 months sideways. Maybe the 5th month says, hey, I'm out of here. And I suspect you get above your little coil top there, around 34.50, you're going to blow right through the roof. We've got momentum reasons to argue that, not merely price. Now, during that 4 months plus, the gold has gone comatose, happy sideways. Silver has gained since its April close as of yesterday's close, the end of the month, 12.9%. Okay. Despite all the sell-offs, silver has gained 12.9% from the April close to the present, whereas gold's gone lateral. Okay. And the miners have gone up big too since the April close. So what do you got here? You got the silver versus, yeah, there you go.
Yeah, spot.
I mean, yeah,
There's
it's
the
hardly, yeah.
April close around here, and
Well, you can see some shelving action even on price. You've got one right there. Yeah, raise up a little bit. Yeah, right about there. Go down, right there. Yeah, go to the high closes in 2021. Yeah, and 20 up there. Yeah, right there. Those high closes. Yeah, drop
Yeah.
down to the close. If you go lateral to the left, high close, not high trades. Top of the candle, in other words. Yeah, right about there. Look to your left and look what happened in 2011 and 12. You were butting up against what had been an attempted floor. Okay?
Yeah, now
And
we're back. We're
restrained
above
it.
that now. Yeah.
Yeah. You fought your way above it after 2 years of congesting below it, 3 years. And look at the pullback since. You've had a couple of pullbacks that sat on that low. We're way above that level now. And frankly, we're above everything except the high month back in 2011. We're above the congestion zone that preceded the bear, which is down lower. But, even price chart is saying, hey, I'm out of here. Why do you keep selling me? I've earned my way. It's not like I've had 10 months up. I've had 1 year of sideways, and now I've had, 2 months up out of that zone. I'm hardly old. By our metrics, you're not at least a bit overbought. And yet everybody's still claiming it's got to go down, but it's up 12.9% since the April close, whereas gold went sideways. What's going on here? Well, it indicates to us that silver and the gold and silver miners are shifting to outperform mode versus the mama metal. Yeah, gold's going to resume strongly, but they're going to outpace us on a percent basis. And I think a lot of that's going to occur between now and year end.
Researchers have long argued that extended periods of low interest rates lead to greater financial fragility. Scholars like Borio and Lowe emphasize that unchecked credit growth, combined with soaring asset valuations, is a primary driver of instability, often connected to prolonged accommodative interest rate regimes. Confidence in central banking is eroding, not solely due to politics, but also because empirical data and academic critiques increasingly point to the Fed as a catalyst in repeat boom-bust cycles. Moral hazard concerns, eroding inflation control credibility, and systemic distrust may drive investors toward inflation-resistant assets, such as gold and silver, potentially triggering accelerated rallies if systemic confidence fractures. As conditions worsen, driven by job losses, mortgage defaults, and tighter lending, some analysts warn the crisis of confidence may extend beyond the Fed to the entire financial structure. This shift could accelerate demand for hard assets, such as gold and silver, as investors seek refuge from systemic instability. Financial advisors point to the gold-to-Dow ratio, which recently breached key historical thresholds. Past spikes in this ratio have coincided with major equity downturns and sharp gold rallies. If economic sentiment deteriorates and market confidence wanes, financial imbalances, as indicated by indicators such as the gold-to-Dow ratio, could trigger a sharp phase in gold and silver markets, especially as investors rush into deflation-resistant assets. Now, let's recall the interview.
Already you've had academics, even some who favor the notion of a central bank, have been saying, especially over the last 6 months or so, hey, they're behind the curve. So even they don't like what's going on inside this Fed. So there's always this, even though they're on the side of the concept of the Fed, they don't like how it's running. Well, if all of a sudden you head down in the stock market in a big way, I don't mean you have to crash, and you get negative data points from hell because we've got a bubble from hell. Somebody's going to sit back and say, you know what? This has been going on for 100 years now since the Fed was created. And they create these monetary booms and busts, and where the money supply gooses, rates get artificially cut low, and the stock market follows, and then there's a bust and so forth. This isn't working. And so even though they may not have an answer, they realized this isn't what we thought it was. And you got to show the people your cup. It's really good.
Oh yeah, here we
Your
go.
coffee cup. And explain to them who that was who that is there.
Yeah, that's Charles Lindbergh Sr., the father of Charles Lindbergh, the aviator. He was a congressman at the time the Federal Reserve Act was passed. And
Yeah.
he said here, and I've got it on the other side, and I'll read it though. He said, this Federal Reserve Act establishes the most gigantic trust on earth. When the president, Woodrow Wilson, signs this bill, the invisible government of the monetary power will be legalized. The worst legislative crime of the ages is perpetrated by this banking and currency bill. I mean, that was pretty, he had it right on, I
He
think.
was dead on.
Yeah, dead on. I brought this up here, Michael, the Dow Gold ratio, because you said that the Fed came into existence and you started getting these booms and busts. And you can see this by the Dow Gold ratio. I mean, it's getting bigger and bigger.
Yeah.
Do you also think, like I do, that we're going to go at least back down to 1-to-1 again?
Oh, can't predict that. All I can say is that the move has just begun in terms of the price dynamics, that likely the 10 years of arduous upside we've seen, but continuous upside in gold, silver, et cetera, is now going to go into a more vertical stance because the external technical and fundamental factors are starting to click into gear now. With like this week's action in the S&P, I think starts the process back down, which is not something the investing public expects. The data points go south in a big way. Central banks start pulling their hair. They get divided. Even the Fed is split. We got two. What happens if suddenly there's four? Powell's got to act pretty soon because if he gets another bad monthly employment report or some other kind of data points that he likes to cite as being true and accurate, which is mistaken anyway, he's going to look political if he doesn't start cutting. He's going to look like he's game playing, especially if four voices pop up. But the question is, when things don't work and you go into a panic mode, and we remember 2007 to 9, the average American might not have been in the stock market, but boy, it hit them hard, family-wise, home-wise, mortgage payment-wise, et cetera. It was very painful. And this one is far bigger, this bubble. The errors compounded are far bigger when they become exposed and you rip the Band-Aid off and people see what's there. And suddenly it's not just the stock market, it's now data points. It's I got laid off, my wife got laid off. We can't make our mortgage payments. Our credit card's canceled, et cetera. I can't pay taxes. Can't afford to, So suddenly all kinds of notions like the viability of the IRS as a source of government funding for government goes out the window and they revert to sales tax. The intellectual support for the Fed goes out the window. Think in a minute, what Lindbergh said. By the way, somebody else said this. My son told me the other day he'd found this quote. Lenin even said, the way to destroy capitalism, there was a economic free economy, is to have fiat currencies and destroy the currency unit. That's the best way to destroy capitalism. He was dead right, and yet we did it anyway. We should have Lenin quote on the wall of the Federal Reserve building.
Amidst a broader shift in investor sentiment and declining trust in central banking systems, silver and mining equities are emerging as market leaders. The technical outlook supports further upward movement, as silver has outperformed gold and broken through multi-year resistance levels. A flight to hard assets like gold and silver could be accelerated by this decline in confidence, as well as economic turmoil. Could a prolonged precious metals supercycle be sparked by growing mistrust of the Federal Reserve? What effects may a breakout in gold and silver have on the larger bond and stock markets? We would love to hear your thoughts, so please share them in the comments box below. If you found this video helpful, please give it a thumbs up and remember to subscribe for future videos. Thank you for joining us on this adventure.